name is Max Gagliardi, and you're listening to the Talk Energy Podcast. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app, leave a review, help me out. This episode's guest is Stacey McDonald. Stacey has a 15-year background working in the capitals markets with an expertise focused on natural resources, energy, and growth companies. Stacey also runs her own consulting firm and sits on the board of directors for Bonterra Energy and Birtchcliff Energy, one of Canada's leading natural gas producers. This episode's filled with discussions about the current state of Canada's oil and gas industry. We talk about the macro backdrop and where we see commodities markets heading. And lastly, we talk about upstream equities and get Stacey's views on valuations, opportunities, and challenges in the space. Hope you enjoy the show. Stacey, welcome to Talk Energy. Thanks for coming on.
Hi, Max. How's it going?
It's going good. I guess we recently connected on Twitter, and I guess you're kind of like old school EFT, Twitter. I mean, I don't know. You were one of the kind of originals on the platform. I know we've got a lot we can talk about today, but you'd mentioned maybe that was something you want to talk about. So what are your thoughts on EFT these days, or energy Twitter for people that don't know?
I mean, it's been really interesting watching how it's kind of evolved. I mean, I joined Twitter in 2015, and I think there was like 4 of us that were talking about E&Ps at the time. There was a bunch of guys talking about like macro and shipping, but that didn't really have any interest to me. So it was really quiet. And I think what happened was a lot of the people that worked in industry, whether it was for an operator or for, in capital markets, kind of took to Twitter to kind of air their grievances on what they were seeing internally. And, to their credit, I think a lot of people that joined kind of in, 2019 and then the beginning part of 2020 were pretty spot on in a lot of their criticisms. And it felt more like a cathartic kind of outlet for everyone. It was really interesting. Obviously it got very popular during the spring of 2020 when oil prices were crashing. There was a lot of people jumping on, but it's definitely evolved now. I think for the most part, people went from being pretty bitter and overwhelmingly bearish to now I think people are coming out the other side and everyone's pretty bullish. Yeah. The only concern I have is when I see everyone that's bullish, it makes me concerned that it's going to like roll over again, but it's definitely a better environment when everyone's making money. So I'm happy. Yeah.
For sure. Well, I think that like everything you're saying, I had been on Twitter, I had an account in like 2009, but never really was that much. Yeah. Never really got on it that much. And then started noticing a lot of the energy stuff kind of like 2019, 2020. And I think a lot of people just complaining, a lot of just like hot take posts. But, I think like what you're saying this last year, maybe it was a combination of people being locked down and just being on their phones more, being online more. But then also like the craziness of prices going negative. And it just seems like now you're really seeing it. I mean, I tweeted the other day, I'm pretty bullish on oil and gas Twitter, just because like I think we are going into this kind of bull market run, and people tend to get excited about things when prices are going up. And it also just feels like it's pretty small comparatively to a lot of other industries. You've got like kind of FinTwit, like finance Twitter, or I guess a lot of that's really stocks and equities. You've got just all these other industries, real estate, and they've got these big social media kind of Twitter presences or personalities. But oil and gas seems to be a little bit behind, but I feel like it's catching up, and it's just exciting to just seems like the evolution of it's cool. It's a pretty fun community.
Yeah, like I definitely seen a shift more from like operator and field level information. Like people used to do deep dives on well performance, and now it's mainly more about equities and trading, which I think is to be expected. I mean, no one was buying. I think even people in the energy industry didn't want to own energy stocks in 2019 and for the first part of 2020. So people were more focusing on assets, but now people are more talking about trading and equities and how to play it. And I mean, it's a great resource because someone always has an opinion that's contrary to you. So to be able to kind of like throw something out there and hear contrarian views, it's a really good way to stress test your own assumptions, because you're not going to be right about everything. So I suspect there's a lot more people lurking. I know just from my own account. I mean, I know some of the people that follow me who I used to, kind of interact with more when I was working in capital markets. And there's a lot of big portfolio managers and asset managers that I think are also using it as a resource. So I think it's one of those things that, if this bull market continues, it's going to become more of a self-fulfilling prophecy. I expect way more people to join and to kind of hop in. But I mean, that's great, right? It's all gravy. Yeah. The more people that are there, the more voices, I think it's better for everyone.
People sure aren't afraid to tell you when they think that you're wrong on Twitter, huh?
No, I mean, everyone's got an opinion. Most of them are anonymous, but yeah, no, Twitter's a buffet. That's how I always say. I mean, you can listen to those people, you can ignore them, or you can engage with them, and it just depends on, their behavior, I would say.
Yeah, for sure. There was someone on the other day that's I won't call their specific name, but they just had got on, and there's somebody that was, putting out actual content, like takes on the industry, and they said, well, back in the day, we used to do this or whatever, and someone commented, like, back in the day, you used to have hair because the person was bald. I just tweeted, I was like, welcome to Twitter. You're trying to put, like, a serious, well thought out industry or market, thought out into the space, and then you just get someone just dogging on you, but you kind of have to, this kind of comes with the territory. And so maybe we can, kind of shift and talk about some things that people may or may not agree with in terms of our views on what's going on right now. But, what do you think about this macro that we're in? And I think that you're a couple years, you've had maybe 3 or 4 years more in the industry than me, but we are relatively aligned with our time frame that we've been in the business. And so, like, can you compare today's macro with anything you've seen historically, or just give me your broad thoughts, and then we'll boil down into more specifics here in a little bit.
I mean, I graduated from university, and I'm going to tell everyone how old I am now, in 2006, but I had been working, my dad ran a bunch of public oil and gas companies, so I'd always been interested in the space. And I had done a bunch of summer terms working in investment banking, so I'd always been involved. And to me, this is a perfect overlay with 2004. I mean, at the same time, you had the tech bubble was imploding. It was the same kind of, rotation in equities that you saw from tech go into energy, and that kicked off a multi-year bull run. So I'm talking more about the equity picture, but a lot of that was obviously driven by what was going on macro. I mean, people thought oil was dead in 1999, right? And it was the same thing last year. And what's changed now is, I mean, the difference between the U.S. and Canada was the U.S. had a big influx of capital through the Permian, and the investment climate, what I would say was unsustainable, call it from 2017 to the first quarter of 2020. And the reason I say that is, I mean, the operators were not being rational. There was way too much capital going into this space. There was no emphasis on returns. It was just an influx of capital. And what's changed now is that's gone. So the operators are forced to perform, and the institutions are being very upfront about what they expect, which is, discipline, return of cash flow, return of capital. But that's being driven by the macro picture in the background. I mean, people thought oil was dead. I don't think anyone on Energy FinTwit did, just because of how much we use it.
Right.
But what's changed, I mean, COVID was obviously the biggest change for the industry, and ultimately I think it's going to be better off because, I mean, OPEC had wanted to kill U.S. shale for so long and they couldn't do it. And COVID managed to do it in a matter of weeks. And what you have now is strengthening oil prices, and you have a more disciplined industry that I don't think is going to ruin it by increasing capital again. So if I'm an institutional investor, I'm looking at a positive fundamental backdrop on the macro side, and I'm looking at companies that are much better positioned now than they were even a year ago.
Yeah. It's like when you think about these things, there's so many dynamics into oil and gas pricing. Everybody wants to talk about the price of oil, the price of gas. You want to talk about OPEC, all the different things that can change the markets. But kind of the leading indicator, and really if you want to boil things down to a very simple variable, and I've been talking about this for a couple of years prior to this to where we are today, and it was just like follow the capital and look at the capital going in, and that's going to be a very good indicator around supply, which is probably going to have a bigger impact on the prices of oil and gas than demand, because demand is, other than COVID, right, and what we've gone through recently, which is this huge shock that you're talking about, really it's kind of like predicting the supply side. And when I looked at a lot of the predictions for even around the price of natural gas, and I'm mostly focused in the U.S., but and as well as the price of oil, it's just, you just saw the flight of capital, and it's been building up to this. And is it that simple? Just kind of follow the capital and see in terms of where the supply is going to go. And I know there's a lot of other complicated things here, but if you really want to boil it down to the most basic thing, to me, that's kind of what's the most important theme right now.
For sure. I mean, the companies have put out big, broad statements on what they are going to do for spending. I mean, they have claimed to be so set on this new path. I think any operator, especially the large caps that deviate from their public capital spending plans, are going to get eviscerated. So, I mean, they're really going to have to stick to this low capital plan. And what ultimately that means is, you know, as you pointed out, demand typically is correlated with GDP growth. There's not too much deviation from that. And so then when you look at the supply side, I mean, when you look around the world, like for oil, I mean, we've gone into, you know, year 7 of lower capital investment. Most of these large chunky projects require years to come on stream. So when you look out, like, where's the supply coming from?
Right.
I mean, if it's not shale, then, you know, it's not oil sands, it's not offshore, where is it coming from? So you've got demand growing and you've got a stagnant supply picture. So I think that's on the oil side. You know, on the gas side, it's a little bit, it's similar but different. I mean, natural gas, I mean, I was always shocked with how much they could grow U.S. supply with so little capital. But I think when you actually break it down and really dig into the plays, specifically now in the U.S., I mean, they just can't grow for various reasons, whether it's the capital or the liquidity of the operators, or, you know, the lack of egress. So on the gas side, you know, ultimately it's going to be a bit of a weather situation, but storage is low and there's not going to be a big supply push. So on both gas and oil, I'm incredibly bullish on both of them. Gas will be a little bit interesting just as we head into the next few weeks with winter. But you know, overall, the industry looks really good, so I'm excited.
Yeah. So I mean, we talked about the capital going in. Then also even too, this has been happening for even longer, really since 2014, is around the exploration and just the finding of the new opportunities, especially like talk about these mega projects, the ones that take years, the offshore stuff. But it's the capital in my mind combined with the lack of exploration, the lack of going out and finding where these new reserves are going to come from. And so as a company, and we'll focus maybe on the public side, because I think that's what you're more focused on, you know, where do you find that growth for your shareholders in terms of, if it's not through the drill bit, you know, everything that's going on kind of right now on the M&A front, it seems like guys are going to have to either consolidate or to buy up other companies. But just your thoughts on how these guys navigate growing their companies in an environment where it's very difficult to do so through traditional capital spending.
I mean, I don't think you're going to see absolute production growth. What companies are going to focus on is debt adjusted per share growth, meaning, you know, we're either lowering our share count through buybacks, or we're lowering our enterprise value by paying down debt because of free cash flow. So investors aren't going to look at an absolute basis, because absolute has been proven doesn't actually generate shareholder returns. So on a per share basis, how do you do that? Well, you do it organically through getting your cost structure down. So whether it's operating costs, capital costs, or, you know, your decline rates are lower because you've been drilling less. So those are how companies can add value. On M&A, I mean, investors and people on Energy FinTwit like pushing back on weak points of various M&A deals, whether their inventory sucks or they overpaid. Right. You know, ultimately a lot of those deals are going to be successful purely based on commodity. So, you know, if you kind of went out on a limb and bought a bunch of assets or bought a bunch of reserves during the downturn, I mean, it doesn't really matter if you overpaid by 10% or 20%. If the commodity price keeps going up, you're going to look like a genius in a few years. So I think it's going to be a combination of M&A and really just digging deep on your operations.
Absolutely. No, for sure. What about, and I kind of skipped over this, I had some notes. On the capital spending side, you know, we kind of glossed over it and said that there's not going to be as much, but just what are you seeing from groups out there in terms of how disciplined are they going to be? You know, do they have the ability if prices really get crazy? I mean, is the discipline tied to price, or is there a price level where that discipline just kind of goes away because it just gets too juicy to go ahead and to start spending some money?
You know, no one wants to break discipline and go first. Someone will do it at some point, and it'll be interesting to see the share price reaction. Unfortunately, we're in a cycle where the share price matters more than the commodity price, which is a pretty sad indictment, because if you're running a company or you're on the board of a company, like, you should be managing your operations, not managing your share price. But unfortunately, you know, if you break discipline, I mean, I think your stock price is going to get smoked. So I don't think people are going to do it. And especially the large caps, you know, they put out these multi-year plans. So I think the industry overall will be very fairly disciplined. There will be a few companies that focus on growth and they will attract a certain level type of institutional investor that wants that exposure. But I think the vast majority of operators won't. I mean, where do people start drilling again? I think oil is going to have to be like $100 before people start drilling, before they break their plans.
So is this
I
like,
mean, when you think about variable dividends, like just as an example, if a company says we're going to pay, we're going to spend 70% of our cash flow base and then 30% is going to go to return to shareholders. I mean, even as they can hold that and say they're being disciplined, but even as cash flow and commodities go up, there's still a larger wedge of available capital. So I think you will see some production growth just because the wedge of available capex that's being driven by cash flow is higher. But I think order of magnitude tops, you're talking maybe 5% per year. So again, even if your production's flat, but you're paying down debt or buying back stock, you're still going to see per share growth. And I think that's what's really going to be driving investor attention.
yeah, this is kind of like is this an indefinite thing? Like, are we just going to be in this low
No,
capital environment forever? Or is at some
no.
point it's going to click and people are going to realize, especially people that maybe historically had done well in oil and gas equities or investing in oil and gas, but maybe they've been shied away for it for a while for good reason because of returns. But are those people going to start coming back, or other people going to start coming back and really looking for growth and for increased expenditure at some point in the future? Or is this a forever thing where we're just
No,
a
I don't
dying
think it's
thing?
forever. I think it's for a couple years. Like I think we're probably 2 to 3 years. Like if oil's $150 next year, I mean, sure, some people will break it as they should. But again, when you look at the cycle times between how long it takes for you to make the decision to spend more money, go and drill, most of them are pads, so they take forever now to actually get them completed and brought on stream. The actual time from when you decide to spend more money to when the production comes on stream can be quite long. So I don't think this is going to go away right away. I think it's going to be a couple years of very good times and very high netbacks for the industry. But I don't think it's forever.
Yeah. It's interesting, like, what else is going to impact these guys' ability to grow? And lately, just all the supply chain stuff going on. And I don't know if you have a take on this at all, but it's been kind of alarming to me the last week or two around the China situation with the rolling blackouts. Now you're hearing a lot of manufacturing, people going down, only being able to open for a couple days a week. And this is all on top of all the stuff we're seeing with the shipping being all backed up in these ports. And and you're hearing it now kind of in the oil field around, at least locally in the U.S., where guys are now having to change their plans. And they thought I was going to run a couple rigs, pick up a rig in Q1. But now I'm talking to my service providers, and they're like, you either need to do this, you need to either tell us now, or there's not going to be availability because we've got high demand, supply chains are constrained. If you want to do it, you need to do it. How much other stuff? I mean, I bucket all that stuff into kind of the other category that's beyond just the price and people's willingness to spend capital. There seems to be a lot of other things kind of floating around that could cause more disruption than people maybe are giving it credit for.
Yeah, I agree. There's definitely, there's a lot of kind of recalibration going on in this space because capital was pulled back for so long. A lot of service equipment was taken offline, and then you're
Yeah.
struggling with bringing that back on and finding staffing. On top of it, a lot of the service companies don't necessarily have the balance sheets to spend the money to reinvest to bring on new equipment. So I do think you're going to see tightness in the oilfield services space. How does that translate into costs that are passed on to producers? I mean, there needs to be some inflation on the cost side for the service companies because they've been running like bare bones for so long with no margin. But I don't think it's going to be, 30%. I think you're probably going to see 10 to 20% increases, call it entry to exit next year in 2022 on the service side. So that will chew into some of the returns. But as I said, like some of the companies are making so much money on a net back basis right now. It's, that's to be expected.
Yeah. So I was going to ask you about your background, and maybe we'll do it I usually do it at the beginning, but maybe we'll do it at the end. The conversation just started getting good. So what about just kind of like, I know you focused a lot on Canada, and I'm in the U.S. So, and I want to get into things like the valuations on equity side. I want to get into things later around how they're going to handle returning value to the shareholder. But before we even go to that, just talk to me kind of high level, or for the listeners that don't have a lot of Canadian experience looking at E&Ps or with that market, maybe compare and contrast the industries between the U.S. and Canada, and then because obviously you have the ability to do so given your background.
Yeah, sure. So, by background, I was the managing director of institutional equities at a firm called GMP Securities, which is now Stifel Canada. I primarily covered small and mid-cap companies. I did cover some U.S. stuff, so I'm obviously quite familiar with the space. It's been really interesting from the outside, and this was kind of what I expected to happen, but, the Canada was very similar to the U.S. in terms of capital investment trends up until about 2014, and that's when things changed dramatically. But it's interesting because you can use that as a roadmap. So in 2014, we all know what happened. Oil prices rolled over, but in Canada, they stayed low. The capital left. There was an exodus of large caps, private equity firms, lending, equity capital. Basically, everything left. A lot of it was, I would call it three factors. One, the energy capital went to the U.S., what was invested in Canada, so that, they followed the growth rate in the Permian. A lot of capital left Canada because we had cannabis, which opened up and became legal, so that took a lot of capital out. And then generalist money left because of tech. Some of those three buckets went into the U.S., so you guys didn't have as severe as a downturn. But what happened in Canada was that massive exodus of capital caused the companies to be extremely disciplined starting in kind of 2015, similar to what happened in the U.S. at the beginning of 2020. So the Canadian companies have had, call it 5, 6, 7 years to kind of get that discipline, get their costs down, and most importantly, get the decline rates down on their base production levels. So we've kind of been biding our time, hanging on, without any outside capital. And in the U.S., they had to do that, call it in one quarter, right? The first quarter of 2020. So I can look at the space in the U.S. and, it's been interesting for me because I kind of have a roadmap because it's what happened in Canada. So I think the U.S. producers are still not as well positioned as the Canadians, in terms of why. The decline rates in the U.S. because of the focus on shale are much higher. So you're on a much steeper treadmill. You have to spend a lot more money on maintenance and sustaining capital just to hold your production flat. The royalty rates in the U.S. tend to be a lot higher just because of your mineral structure, whereas in Canada, most of the mineral rights are owned by the province or the crown, so our royalty rates tend to be about 5%. And on top of that, the exchange rate, right? We pay costs in Canadian dollars, but we receive higher pricing. So when you compare and contrast, I think there's U.S. operators that have done quite well and been able to pivot, but overall, I still think the Canadian names are much better positioned overall for equity performance.
That's interesting. Those are all really good points. What are valuations like for these Canadian public companies? I don't follow it hardly at all in terms of. I'm not as big of a stock guy as a lot of people on Twitter. I feel like left out. I feel like I need to start making hot takes on stocks because that seems to be what everybody wants to talk about. But what are the valuations like for these Canadian companies, in your opinion? To the extent that you can share, just kind of, and I know they're all different, right? But just broadly, what's it looking like?
Broadly, I would say kind of the non-large caps, the Canadian producers probably trade at 1 turn discount. So whether you're looking at, debt adjusted cash flow, they trade at probably 1 point discount to the U.S. I think that's a bit unwarranted just because of the underlying fundamentals. But a lot of it's just driven by the fact that, the investor base in the U.S. is significantly larger than Canada. So if you, Max, were a generalist portfolio manager and you're like, oh, wow, I've really missed this energy window. I need to buy something right now. I mean, you're not going to go to Canada first, right? You're going to buy Chevron or EOG or something like that. So they tend to have kept a higher valuation just because they have a larger investor pool to focus on. So I do expect that will change over time, but I mean, it is what it is, right?
Yeah. Has it reacted the way, you also see a lot of people that want to tie kind of, whether that be news headlines, whether that be just, price movements, right? You see the move price in oil, or you see the move in gas and natural gas, and tying that to these equities and how they perform, and you see people scratching their heads sometimes. It's like, well, why aren't they moving the way you think that they should? I mean, has the market for Canadian equities, is it kind of playing out the way that you would think that it would with the backdrop of everything, or do you still think that there's some dislocation and value to be had there?
I mean, what's been really interesting is if you, as an outsider, pull up a stock chart, you probably are like, oh shit, I've missed it, right? Like, I don't want to buy it. Look, they're up like 300%. But you can't look at it with just that lens. You have to look at it in terms of valuation. And because the cash flows have improved so dramatically over the same time period, for the most part, both US and Canadian stocks are actually cheaper than they were at the beginning of the year, even with the rally, because of multiple compression. So, I always tell investors, like, don't worry about it. This is like, we're in the first or second inning of this. The stocks are not expensive. You haven't missed anything. I mean, you have to get on board at some point, but I mean, you haven't missed it. The real money hasn't moved into energy yet at all. We're not even close to being even an equal weight. The investors, by and large part, are still underweight. So if you, as a retail investor or a small investor, you manage your own book, just get in now, buy something, because I mean, we haven't really even got going yet.
Yeah. So what are the? No, that's a great point. I love that, and that's probably what get everybody excited on energy FinTwit. But what are how are these guys going to return value to their shareholders? You talk about a bunch of different strategies that guys are doing, that people are doing out there. But what are your thoughts around just in the Canadian companies specifically? Dividends, share buybacks, debt repayment. I mean, just your general thoughts on how they're going to best go at returning value to the shareholders.
It's been interesting because I think 2020 was so scary for many of the executives and boards because, the number one thing that can cause you to lose control of your company or the company you run is debt. And what happened was, I mean, you saw the lenders get scared, and that I think has created a residual fear in the companies and the people making decisions about how they go forward and return capital. So debt repayment will be first, just because people have that in the back of their mind, like, I don't want to go through that again. So what you've seen is companies kind of put out debt targets. Once we reach this level of debt, then we start returning cash flow. Ultimately, where interest rates are, I think the smart move is to probably have a little more debt than the companies are guiding to, because you need to have some debt on your balance sheet. But I understand why they're doing it, just because, I mean, when you're dealing with an outside party, whether you have a reserve-based lending facility or a banking syndicate, I mean, you're somewhat dependent on them for your survival, and you want to take that option for them away. So that's why people are overpaying down debt as step one. Step two, we've already started seeing happen, which is the shift to dividends and buybacks. So whether there's special dividends, regular dividends, variable dividends, or large buyback programs, that's starting. I would expect with the release of Q3 earnings, you're going to see a lot more of that. And I think that will drive some increased investor interest because, I mean, let's be frank here, investing in energy has been a nightmare for most institutional investors. I mean, if you're a portfolio manager and you have to go to your chief investment officer and say, let's buy energy. I know I was wrong the last 10 times, but this time is going to be different. They're not going to believe you, and you're not going to risk your job, right? So I think investors are comfortable missing the bottom, but now that you're seeing these types of news items in print, either happening right now, I think people are going to start giving the companies credit. I mean, it's not really a leap of faith to say companies are going to pay dividends when they're actually declaring them, right?
Yeah. How does the dividends and these strategies to return shareholder value, how does that roll through on the hedging side, the risk management side? How many of these guys are, and again, I follow it more in the U.S., seeing the gas producers take some pretty big hits because of their hedge positions, but how are these guys going to do the risk management moving forward? Are they going to be able to capitalize on some of this upside, or are they going to be so hedged out, and the only way to capitalize is maybe through the drill bit, which they're not going to do? Or just talk about risk management with these companies. How are they thinking about it?
You can tell who the guys that were getting stretched by their banks were, because they were the ones that were forced to put on a lot of hedging in the middle of 2020. And unfortunately, they didn't just hedge short term. A lot of them have hedged 21 and 22. So, I mean, that's definitely going to hurt your returns. The gas guys are incredibly hedged, which is, very problematic. I'm sure they're all crying about that now. Yeah. But I think, typically you would drill, like you mentioned, drill your way out of it. So try to bring on more molecules. But you've already said that's not your plan. So you're not going to see a lot of variability in some of these cash flow forecasts, especially obviously for companies that are more than 50% hedged, because you're still going to end up losing. So if I was an investor, I mean, try to focus on the companies that have either hedging rolling off or kind of, even just 30 to 50% hedging. One company I'm on the board of a company called Birtchcliff Energy. So we're about an 80,000 BOE a day natural gas producer. And I mean, we didn't hedge our gas. We're one of the only producers that's in North America that didn't hedge our natural gas exposure. So we're pretty excited about that. But again, part of that's because we weren't pressured by our banks because we had a good balance sheet, and we're a low cost producer. So we don't need to be the first one to hedge, right? Because we're going to outlast all of our peers. So, when I'm looking at companies, some of it will just be driven by equity flows. The investors or, the algos won't really look at who's hedged. But if you're an individual investor, I mean, obviously try to focus on guys with less than 50% hedging.
Yeah, for sure. It just seems like some of this stuff is you have to look a little deeper to figure out kind of which company you want to get exposure to or not. I do think that on the equity side, you've got to have more capital coming into the space, given all the things we're talking about in this kind of like energy crisis thing that's going on here worldwide. And I don't know how, everybody wants to point to the ESG stuff and say, look, this is what happens when you focus on investing in renewables, which, yeah, I mean, that's happening, right? You have seen the lack of investment in E&P, but a lot of it's been driven too by bad returns as well. It's easy to make like the renewables or the green stuff into the boogeyman, but some of this stuff in the energy crisis is definitely COVID related, supply chain related. Other stuff is the ESG push. But on that topic, how much is the kind of the ESG and just this whole trend of the green movement, how is that impacting these Canadian companies? I think I know the answer, but just your thoughts there.
I mean, typically when you look at ESG trends, especially in the industrial sectors, you tend to look as a Canadian towards Europe because they tend to lead on the ESG file. And then the Americans tend to follow Canada. So when I look at the environmental landscape, I mean, if I'm running a company in the US, the environmental rules and the ESG rules are going to get more stringent over time. They're not going to get less. It's just a question of now what the pace of those rules are. So obviously in the US, there's been a big push focusing on flaring, which needs to get rectified. In terms of environmental and ESG impact on stocks, I think it's like you mentioned, it's one of those things where the stocks are weak, so people just try to fit a narrative or a story to it. In terms of discussions with investors, yeah, I think you have to do the work as a public E&P to show that you care about ESG. So whether you're doing sustainability reports or tracking your emissions or filling out all those ESG questionnaires for all the ESG monitoring firms, you have to do that stuff. It still is a very low cost investment, and I think it's a must do. Do I think that ESG funds, specific funds with those mandates, are ever going to invest in the oil and gas sector? No, absolutely not. They don't care. They're never coming back. But that's fine, because if you're able to show that you care about ESG, it probably brings an incremental generalist money investor that might have stayed away. So I think it's a fool's game to try to target ESG funds to investing in oil and gas. It's just never going to happen. But as I said, I think if you can show that you care about it, I think you will attract incremental generalist money.
That's kind of what I was going to say. Is like it feels like you got to check the box for
You
that
do.
stuff. I don't know that it like necessarily increases, shareholder interest. Maybe it does if there's somebody that's on the fence and they can say, look, I've picked the best in class kind of E&P operator on the ESG. I guess let me put it this way. I think it obviously hurts you not to do it. I don't know how much it really helps you in terms of like if you're doing it really well. I think it's just kind of like it's a thing that you have to do. I'm not sure that the people that are going to play in this space from an investment standpoint, they're probably going to play in the space because of the returns and generating, they want to generate returns for their equity investment. So I think that's what's driving the decision. But I don't know. It just feels like the downside is huge on not focusing on it because you kind of have to. But I don't know that there's really like a lot of upside where these guys are going to get some premium valuation.
I think you have to look at who the audience is for ESG. And I think one of the things missing from the discussion is it's not just about ESG for investors. I think the industry needs to focus on ESG because they need to show the picture to the policymakers. I think that's much more important than focusing on investors. For example, in Canada, I mean, we are a net exporter. We have outsized emissions because we export our hydrocarbons. So we're not the ones burning it, but we still have outsized emissions because of it. If our policymakers in Canada and the US are left-leaning and they have a mandate to do something about climate change, it's very important that the industry has a seat at the table and is showing that they're doing good things, because the worst thing to happen would be, to be obstinate or to not participate and have rules put on you or regulations that cost you money. So from an ESG angle, I think it's important that industry care and move the needle, but that has more to do with making sure the governments don't force you to do it on your own, because the cost of inaction on a lot of this ESG stuff, whether it's flaring or methane regs, the cost of not doing anything is gonna get worse. So you're better off as a company just to get going on some of this stuff.
I think you're making a great point. It's like the education around the legislators and trying to bring it to their attention that, look, here are the options for how we can tackle this. Here's what we're doing. One thing that I've focused on is looking at the impacts of kind of offshoring carbon, or just like the impacts of even these projects that get shut down, like pick on like Keystone Pipeline, 'cause it's way too easy. But it's like, what's going to happen to that product? It's going to, they've effectively increased the CO2 emissions for those same barrels. They've made it worse. And if your goal is to protect climate and the planet, which when you look at politicians, maybe or maybe not, that's their goal, right? I mean, they all have lobbyists, special interests, and constituents that are driving them to make decisions. But ultimately, if the climate or if the environment is the goal, we can look at the impact of the decisions that these people are making. So offshoring carbon to OPEC or shutting down projects, it's like, look, if Canada's got great regulations, which so does in terms of, I say great, I'm not like praising. I mean, you have to have regulations, obviously, but if the policymakers believe that their regulations are good, wouldn't you rather have the production under your regulations versus just stopping the production from happening and pushing it somewhere else? I don't know. It just seems like maybe that's too logical, but it definitely, I think they should be focusing on the policymakers, like you said.
Yeah, for sure. And I mean, the perfect example of that is what BP's doing, right? So, you sell assets which lower your company emissions, but you're selling them to a less stringent operator. So net, global emissions are probably up. But then you go and you look at the ESG scorecards, and BP looks better because they just offloaded all their emissions to someone else. Yeah. So there's no nuance right now in that discussion. I think there will be more, just because what's going on with the potential energy crisis in the background. There'll be more of a focus on that. But no, there's not nuanced thinking around ESG and emissions yet. And I'm hopeful we'll get there, but I'm not.
That's why we're doing these podcasts, so you can have kind of a long-form discussion. And, look, what I found is that, and I've even gone into like Twitter, like or Clubhouse or Twitter Spaces, and talked to people that are in the sustainability movement. And I feel like if you can have a conversation with someone when they're very against a certain thing or policy and say, look, here are the outcomes, it's very nuanced. We can actually lower emissions or, be better stewards of the ESG or the environment through doing things, domestically. And that's actually the best option for us, and kind of walk through that. People seem to be willing to listen. The problem that you're making is that it all just kind of gets wiped away in broad brushstroke narratives that you see on TV or at the political level. And so, anyways, that's a topic that it's like you could talk about it forever, because it just it's something that's always out there and you're seeing it so much. But want to get down more into like some of the micro of Canada and talk about, real quick, just in high level overview from an E&P. I mean, obviously you've got shale in Canada, you've got oil sands, but just kind of touch on the different, types of production in Canada. And I don't know if you know the mix, but in terms of what are all the different ways to play the E&P side in Canada and the different types of companies that are out there in the space.
I tend to split the space into two sections, which you highlighted, which would be kind of the oil sands super majors, so the Canadian Natural and Suncor, Cenovus of the world, and then the intermediates down, which tend to focus on shale plays in the Western Canadian Basin. So that would be primarily Saskatchewan, Alberta, and British Columbia. Most of the capital on the kind of shale side has been focused on the Duvernay and the Montney, with the Montney taking the most of the capital. So it's, we don't have as many shale plays or resource plays as the U.S., certainly not as of the scale of the Permian and the Eagle Ford, but I would happily stack up the Montney against any U.S. play in terms of quality and scope. So the kind of higher profile, higher valuation Canadian public equities tend to have kind of Montney or natural gas resource plays outside of the oil sands.
I want to talk about the Montney. That's one I had on my list, and I don't know a ton about it. You compared it to the U.S. shale plays. What's like the best comparison, if you can, between some of the stuff in the L48 How do you compare the Montney? And then maybe we can talk a little bit of shop. I don't know how much details you know about it, but I don't know much about it. I kind of know generally the characteristics of the plays here in the U.S., but maybe just a primer on that.
I don't want to disparage the Montney by comparing it to one of your plays that I don't hold in high regard, but I mean, the Montney covers a very large area. So there's pockets that are dry gas with no liquids, parts that are 20 barrels per million and parts that are oil plays. So from that sense, I would say it's a little bit like the Eagle Ford because you're seeing those different windows, except that it's a much better fundamental play than the Eagle Ford. So companies, you can get Montney exposure. If you want to play it through condensate, you could buy a company called ARC. If you want to have more of a dry gas producer, you could get into a company, dry gas, not necessarily Montney, but deep basin would be like Peyto or Tourmaline. So most of the Montney producers tend to be, call it, 80% natural gas, 20% liquids, and most of that would be associated from the Montney. In terms of well cost, I mean, it really ranges because, like I said, it's, many multiples of size of the Eagle Ford. But, well cost can go anywhere more on the conventional side, anywhere from $1 to $2 million a well, all the way up to $8 million a well Canadian. With the vast majority of the wells kind of falling between 3 to 5 million. From that, you would probably see anywhere from, call it 5 to 8 BCFE, and liquids yields anywhere from, call it 10 to 50 barrels per million. And in Canada, when we lost a lot of our capital investment, the government decided to put in a very favorable royalty structure, which allows you effectively to deduct the well cost before you start paying full freight royalties. So for a lot of the companies, their corporate royalty rates are only between 5 and 10%, which is obviously much more attractive than similar U.S. plays.
Yeah, so it sounds like the economics are looking pretty good right now there.
Yeah, they're great.
That's awesome. Are they going to be able to grow production? I mean, just with, where it's at?
Well, they won't. They could.
Yeah, they could.
I mean, the inventory depth in the Montney, when you normalize it to the size of the companies, would be well in excess of anything in the U.S. I mean, in the U.S., you're already hearing lots of discussions about well interference from parent-child wells in both the Permian and the Eagle Ford. The Montney doesn't have those issues because you're dealing with a play that's, hundreds of feet thick with multiple different zones over a much larger surface area. So, companies will have hundreds of thousands of acres of inventory and thousands of potential drilling locations, where in the U.S. you look at similar size intermediates, their land bases are almost a joke when I look at the total net undeveloped acres. So inventory depth is going to become extremely important, both for the U.S. and Canada, especially with the shift to free cash flow. Because, one of the themes of this is, if we're not in land acquisition stage and we're not in exploration stage, we're in, economically drill our inventory. So as an investor, you can't look at free cash flow yields in isolation. You have to dig into how much inventory they have left. Because a producer may be free cash flowing 20% a year, but if they only have 3 years of good inventory left, I mean, that model doesn't work. So typically when they don't have enough inventory, they go out and buy something, which means you're going to get diluted as a shareholder. So as an investor, whether you're looking at Canada or the US, you really need to spend some time looking at the quality of the inventory depth when making those bets.
Do you think that, I have an infrastructure background. I've worked on the E&P side my whole career, either for E&Ps or representing them with our current company. But I'm always got an infrastructure mindset when I look at things, and really, how do I sell the product? How do I maximize the value? Is that something that could be the constraint? Because you always, it seems it's easy to gloss over, okay, we've got this much acreage or you got this many locations, but there's real, and again, I don't know where the productions, I don't know the area as well. So it's is there excess capacity in terms of gas, processing, takeaway, oil takeaway? Or will there be constraints around, even if guys did want to get after it, what challenges or what opportunities could there be around the infrastructure side?
On what's really changed in Canada is we are at the end of the pipe. You guys were, the U.S. was typically our only customer. So when things got tight on the egress side, our differentials blew out both on the gas and oil side because we're the very end, right? That is actually changing right now, and I actually think the setup's really good. So 2 things have happened. First, our horrific oil pipeline situation seems to be getting rectified, even though KXL was canceled. Trans Mountain's going to be coming on hopefully in a year and a bit. And on top of that, we had line 3 and hopefully line 5. So we go from a situation where we don't have enough takeaway capacity and where we're railing barrels to a situation where we have enough takeaway capacity for, a significant period of time. So that'll keep differentials tight, which will help netbacks. On the gas side, building big natural gas and LNG projects in Canada is incredibly slow. We started around the same time as the US, and now you guys have like a gazillion projects, and we still don't even have one. However, we are going to have a large LNG project called LNG Canada coming on stream in the next few years. And just as a, order of magnitude, Canada produces, call it, 16, 17 BCF a day of gas. And that project will be anywhere from 2 to 4 BCF of gas. And if you think about that, those are molecules that are going to go out the West Coast. But if companies are just using their existing production to fill that, you're just taking all of that demand out without adding incremental molecules to the basin. So I'm very positive on both the natural gas and the oil side in terms of infrastructure and how that impacts differentials in Canada. And that's been a huge change from when 5 years ago I would have been complaining nonstop about this, but now that both of those situations are completely rectified, and you've seen it in the differentials react already.
Yeah, that's great. It has to be there, and it's just inelastic, right? You talked about earlier the amount of time that it takes from when someone decides to ramp up activity to when it actually happens. And then and that's just on the upstream side. You consider the midstream and downstream piece to it as well. So many moving pieces that ultimately have to get this product to market, and it just seems like again I don't know the politics around Canada. I know it's getting harder here in the U.S. with some of the things that they're doing, but it seems like that's all good news what you're talking about, because for the longest time in my career when I bring up Canada, those would be some of the issues that people would talk about, were the bad differentials, were the inability to move product, and all the bottlenecks. So that's a positive. And to shift over to kind of like the oil sands side, the little that I know on oil sands, and I had some exposure through an investment group that had invested in a vehicle that we had put together. They had a lot of oil sands exposure. So talking to those guys, I knew just kind of high level what was going on. I guess that the way they described it to me was there had to be a lot of investment up front to get the facilities needed, but then once it got going, you're kind of just generating a bunch of cash flow. Talk about that space and the health there and what's kind of going on.
Yeah, so you nailed it. It's upfront, very capital intensive upfront, especially for these large mining and thermal or SAGD projects. We saw most of the big investment happen from 2011 to 2016. Crazy cost inflation, but that's all done now. There won't be any more mega projects. So you're in a situation where the outsized amount of capital that was spent on these projects is already in the capital structure of the companies. So they've already paid for it. They've already issued equity, or it's on their balance sheet. And now you're in a situation where you have companies, and oil sands, for lack of a better term, mining has a 0% decline rate. So you're in a situation where your capital's already spent, and now you just have the most stable amount of free cash flow you could possibly generate. And that's why I continue to think that, looking at, this potential energy crisis or supply shortage, whatever you want to call it, I think that oil sands are going to be some of the most valuable E&P assets or oil assets globally, specifically because they don't decline. The super majors during the downturn couldn't get out of Canada fast enough, and I think all of them are going to regret it because they're going to wish they had that base level of zero decline production.
That's really nice. The treadmill is real. We talk about, this global peak demand, narrative that everybody wants to throw around, and hey, look, you see like these headlines and stuff. Well, hey, oil demand is going to peak here, or oil demand is going to peak there, and so therefore, the oil industry is dead. And I'm kind of like, guys, even if oil demand peaked, just keeping oil flat is a massive, massive thing that we have to invest into doing. And so, to what you're saying, that's important. Lower declines, you've actually mentioned it a lot, and I've keyed in on it, is kind of where in the life cycle of declines are these companies. And it's a hugely important, I don't know if hugely is a word, it's a very important,
it's the most important
aspect
of
these
important.
Aspect of these companies. And I'll use my backyard as an example. Oklahoma had a lot of drilling and activity the last 4, 5, 6 years, and it just fell completely off a cliff. When rig count dropped, the amount of production that we lost is like staggering. Mm-hmm. And so when investors think about, the world, just realize that there has to be so much investment just to run in place. So I don't know. What do you think about these like calling the peak oil narratives and like, you know, the industry being dead and now we're just, you know, this antiquated thing? Like I'm not buying it.
Yeah, I mean, oil and gas CEOs, I'm probably going to get yelled at for people on Twitter by saying this, but I think that running or managing an E&P business is one of the hardest businesses you can do. I mean, show me another business where you lose, you know, 20, 30, 40% of your customer or your product every year, no matter what you do, which is your decline. And then try to do that, manage your business in that environment when oil prices are negative $37. I mean, it is a very, very challenging business just to hold flat. It's a struggle, especially when you don't control the commodity price. And I think investors, well, not investors, I would say the general public don't appreciate how challenging that is. And that's why I always talk about decline rates, because if you slow drilling, like many of the companies did after COVID, your decline rate will naturally start falling. If you take spending to zero, it's going to fall hard, and that's what you noticed happen in Oklahoma. But as these companies spend less and less money, or as they, you know, retain that free cash flow kind of capex profile, the decline rates should naturally come down. And this is one of the reasons I continue to like Canada better than the US, because we started this process 5 years before you. I've looked at data. I would say that the decline rate in Canada, excluding oil sands, is probably at least 10% lower than it is in the US on oil plays. So the Canadian companies have to spend significantly less maintenance and sustaining capital every year just to hold their production flat, let alone growing. But that kind of decline rate picture is getting better in the US. It's just going to take time.
Yeah, definitely. Well, it's a big deal. And when you look into these different plays like the Permian, for example, and just the mass amount of new rigs and new drilling that happened the last few years, to your point, you have to look at decline rates and what that fits into the picture. And we just get so lost in this business. Like when you look at people talking about macro, you talk about storage, people talk about, you know, and gas on the injection side. I don't see people talking about decline rates enough, because the base matters. Like the composition of the base of that production, it matters, and it can be, every barrel is not created equal in terms of a production base. And so I just don't know. Why do you think people don't talk about it? I just don't see people talking about it as much. It's like it's too complicated. And it's probably hard to estimate. I mean, maybe it's not. Maybe if you just kind of know the amount of drilling. But I don't see that narrative a lot talking about decline.
No, I mean, a lot of it has to do with how much public data you can. So as an outsider, as an analyst, if you can get the public or the granular data, you can calculate the decline rate. The issue I have, and I'm probably talking a bit out of school here, is, you listen to conference calls for a lot of the US-based intermediates, and you have the analysts asking the management team what their decline rate is, which tells me that they're not actually figuring it out themselves. Yeah. So, I mean, you can game the decline rate as a management team depending on, how you split out the data or what months you pick, but you need to do that type of work. So companies that tend to have more what I would call conventional asset bases or business units like oil sands or other older mature assets, whether they're on water flood or enhanced recovery, tend to have lower decline rates. And I think those are a great way to play it because they require so much less sustaining capital. But yeah, the shale, the shale treadmill is painful to get off of, and we saw that. So I just think, it needs to be that decline rates and, your inventory. Those are what's really going to drive, whether or not you're a quality company long term. Right now, where we are in the cycle, I mean, you pretty much just want beta. You want exposure to energy names. Later on in the cycle, we might care a little bit more about it. But right now, I mean, most of these stocks, other than any blow-ups, most of them are going to kind of trade very similar. Yeah.
Okay, so it's all been easy questions at this point. I'm going to move to what are your predictions around the price of oil, the price of natural gas? We'll start with oil. It's a little bit more global, but yesterday, or I guess it was Friday, David Hyken, I don't know if you know Hike or not, but we do like a weekly kind of call and podcast, and he was asking me, do you think that the price of oil is going to settle above $100 in 2022? And I gave him my answer, but I'll kick that question to you. What do you think?
Yeah, I do.
Yeah.
Yeah,
Me too.
for sure.
It was a pretty easy one for me to. I had the
Oh, I've
same
been saying
question.
that for a while. I mean, I'm not going to sit here and like give you some like proprietary reason why I think that or some supply demand model. I mean, the price of oil was completely irrational on the way down, and it can be completely irrational on the way up. It's an emotional trade. People are going to feel like they're missing it, and people will pile into a sector that's working. So, yes, I absolutely do think oil can settle above 100 in
Yeah.
2022.
What do you think gas will? Do you think gas will average above $4 average for the year of 2022?
Average four? Yeah, I do think that's possible. I mean, we're gonna have spikes this winter just based on the storage picture. So as an average, yeah, I do think it'll hit above four. I mean, a lot of it becomes a question on weather. So for me, I'm
Right.
pretty interested to see what's gonna happen in call it 3 to 4 weeks when you start getting some of those projections for the first few weeks of winter. Because I think people, they buy into the bull story, but I also think people are a little bit scared that if we get another winter like last year, it might be weak again. But with everything going on on shortages for natural gas, there's very strong underlying fundamentals. So I don't think it's going to roll much below four.
Yeah, I hope not. I mean, in our business, we have exposure to the price of gas. So it's, for me, I feel I just have so many battle wounds of it not being what I want it to be. But when he asked me that question, I just said, God, I hope so. I hope it averages above $4. That would be a fantastic outcome for me personally and for our clients. But it's just tough because you've seen it so much in the past where you get this breath of optimism and then it kind of breaks your heart. But this just feels different this time, right? And plus, like, where it's moved, like, it's one thing if we're kind of hovering at 4.10 or right around $4, kind of right over $4, and if we're at that point and that's where it ends up being this winter, then I think you're probably not gonna you're not going to average over that. But like, if this winter, if it can continue to stay over $5 and it gets closer to $6, it just, man, that gives us a lot of breathing room in terms of how much it would have to fall and stay there for it to average under four. So I don't even know when the last time. Do you even know when the last time we averaged over $4 for Henry Hub?
Oh, I don't even know.
It
It's
had
been
to
a
be
long
like
time
a
for
while.
the Alberta price. Yeah, for AGO.
Yeah, I guess
And I
for
mean, in the
the
winter,
US
you
side.
tend to get price spikes. So that's why you, as a natural gas company, you want to market your gas to more than one place, right? Whether it's California or Dawn or some of these other basins, is some of it will be based on what's going on regionally with weather. I mean, we always joke that a lot of the natural gas contracts are traded in the east, so it tends to go up when it's like cold in New York because the traders are just like looking out their window.
Yeah.
So I expect that to happen again this winter. But I'm a bull on natural gas for a lot of long term reasons, doing with electricity and transitioning the grid. But I myself, even being bullish, I did not expect to see these levels of natural gas pricing during shoulder season. But
Yeah.
this time, I don't want to say this time is different because like I don't want to jinx it, but it definitely feels like this finally is going to kick off the similar to '04 bull market run that we've all been waiting for.
Yeah, absolutely. Only a couple more here. I want to be mindful of your time. I was about to be in an hour, but anything when I answer this question, when people ask me about the U.S. and how like the election last year is going to impact things, a lot of times I'm just kind of like, not much, because there's so much of this is beyond control of D.C. here. But any implications for the recent election or anything on the political side that you feel like is noteworthy from Canada that you can touch on, whether that be at the more the local level or at the national level, just any implications of what's going on politically.
I mean, in Canada, we just had an election. We ended up with exactly the same result we had
Right.
before, so it was a big waste of time. So
Yeah.
I don't really see too many implications from the Canadian election. I mean, when I look down at the U.S., the biggest thing that I think would change would be just a shift to the US is now going to have a problem building big things. So we couldn't build pipelines in Canada, and that shift is obviously going to be coming to the US. I don't think that necessarily is completely dictated by who's in the White House. It has to more to do with state level and just increasing activism on the environmental side. So the value of existing pipe and existing infrastructure will go up over time, just because there's going to be less of it being built. And it takes so long for that stuff to get built now. So I think that's the biggest takeaway for me is, I mean, as a midstream or an infrastructure company, it's going to be a lot harder to kind of grow your base business, but the value of your existing infrastructure is going to increase.
I like that take. I've not heard that take extrapolated on much. I've heard people kind of mention it, but that's an interesting theme. I think that, the downstream stuff is pretty well regulated, so the ability to capture additional value there, I don't know how that will, what their ability will be to do so, but at least at the midstream level, I think you got more pricing power. Whenever there's not 10 private equity groups trying to build new midstream facilities and you just kind of have the legacy guys because of either the flight of capital or the lack of growth, now those legacy guys, especially if they have you by the wellhead, have much more leverage. And as contracts roll off, which fortunately and unfortunately, I always say that like a long-term infrastructure deal that cuts both ways, because how could you ever plan for 20 years in this business, yet people sign contracts all the time?
Yeah.
They're like 20-year agreements, and it's like, well, but for guys that have like, relatively short duration in their contractual structures and that are legacy existing players, I think that's a kind of a cool theme to think about, is how does the value shift to those guys, because it's going to get harder to build new stuff. But that could probably be a whole other
I'm
pod.
overall pretty negative on the midstreamers in the U.S.
Yeah.
I mean, historically, they've tend to make returns through volume, not through price.
Right.
And it's going to be increasingly hard to get those volumes up. Also, if you're a large midstream company and you've typically grown 5 to 10% per year, you do that by adding chunky projects, right? It's hard to move the needle on some of those big companies. So, I mean, they're going to have to get really creative on bolt-on stuff to get, their internal growth rates up, but it's going to be hard. So I would expect, on the midstream side, you're probably going to see a big focus on dividends and buybacks, just because it's going to be really challenging to grow organically in a material way.
Yeah, it's a challenge in general. I mean, everything about that space I think is challenging, but to your point around growth and then how does that roll to valuation? The problem is that like the valuations are just they're still really robust for a lot of these companies to where acquisitions become problematic, because how can you pay, an attractive multiple to acquire something with at the same time, there's just not much arb left in there for you to add value. Maybe it doesn't matter because you can just increase distributions. And so even if you overpay, that you're not looking at it that way. But I just think that like a lot of the private guys are, in some cases, severely under their equity cost basis in terms of what their company's worth on a discounted cash flow standpoint. And there's a lot of people in that boat, because I mean, the payback periods on these midstream projects, even the good ones, are 6-7 years sometimes, with a lot of growth. If you spent hundreds of millions of dollars in 2018 and then the rigs didn't show up, like your payback period may be 15 years. I mean, like some of these, a lot of these assets, it's just kind of this field of dreams, build it and hope that they will come. Well, they're not coming. Rigs aren't coming in a lot of these basins. And so then it becomes, well, does that equal an opportunity for the public guys to scoop up assets? And the problem is they already have assets. They have assets that are becoming empty, and they need volume, not assets. And so it's an industry with too many assets, primarily in these other basins. Now the Permian and areas with high growth, there will continue to need to be investment, but it's a tough space right now.
Yeah, the valuations are too high. So you can't, like you said, you can't transact, and no one wants to crystallize a loss on the private side. So they basically just like, no one moves, no one gets hurt.
Right.
And they just sit there. But there needs to be consolidation in this space. I think in Canada, one thing that's different is most of the E&Ps own and operate their own infrastructure. So you don't have that outsourcing of processing or takeaway. So you're able to control your capital spend and not be influenced by, take or pay agreements. I would like to see more of that in the U.S. from the U.S. producers.
Yeah.
But there's a lot of things that need to happen first before.
Yeah, absolutely. Midstream space has got its issues. Like I said, I hadn't done a ton of content on it because I just talk about it every day, and I'm trying to get people on that I'm interested in that do things that I don't do. But it's like, it's just it's in a tough spot. So we're coming up around the hour. This has been a great episode. I honestly I feel like I've learned a ton on the Canadian side that I didn't know, and hopefully anybody that listens will as well. But just, we haven't talked a bunch about you personally. Like, what are you up to today? You talked a little bit about what you've done. What are you doing now? What do you want to do? You're obviously good at this content stuff. Maybe you should start doing more of this. I feel like you're pretty
I don't think we need
articulate.
any more energy podcasts. We're good. No, I was an analyst for a long time. It was a long slog. And I'm on 2 public company boards right now. So Birtchcliff and Bonterra, so a gas and an oil producer. And then I also have a consulting business. So I'm working on a large infrastructure file right now that I can't talk about. And then I do some consulting for some other we'll call them stakeholders that are looking at assets in Canada. So those kind of three things keep me really, really busy.
Pretty busy. What's best place for people to find you for the consulting stuff, or if you want to put a plug in for your consulting stuff? I always give people a chance to plug with you.
You know what? I'm good. I'm all full, so I don't need any more. I don't need any more consulting clients. But I mean, if you're normal and not a creep, you can contact me on LinkedIn. It's Stacey McDonald, and usually I'll respond.
That's tough to find the normal ones on LinkedIn, is what I
found. The worst notification is a LinkedIn message. So.
Oh yeah, I get a lot of weird stuff on LinkedIn. Yeah. Especially with the podcast now, I get a lot of weird stuff in general. But Stacey, it's been fun. I appreciate you. I think I tweeted out. I was like, who do I need to have on? And someone threw you out there, and I'm glad that you were a good sport and came on and did it. But I think also maybe hopefully in the future we need to get you on like a Spaces. I know you've done like with Chuck, you did it on the Clubhouse deal. But and I don't know if you know David Heikkinen, but we're going to try to keep doing more Spaces. So maybe I can twist your arm at some later date to do
for
something
sure.
Again.
Maybe next time we can talk like. We'll go into like specific stocks because I know people want to talk about that too. So
they love it. I mean, honestly, that would probably be like the most popular content, and that's where I've struggled with like, it's EFT, Energy FinTwit, and I'm just not like the FinTwit thing is really just like a bunch of people that like to gamble and want to know about individual stuff. Everybody's always asked me that. Like I get people blowing up in my mentions on Twitter being like, how do you play this? What stock to play what you just said? And I'm like, I don't know. I'm focused on running businesses and like doing podcast. I don't know. Like I'm not like into that. I don't dig as deep into the equity stuff because
I still do. I mean, I covered stocks for a million years, but when you're a publishing analyst, you can't actually talk about them outside of what you write. But now I'm like unfettered. I can talk about whatever I want because I don't have a compliance department breathing down me. So, I mean, I'm happy to talk about stocks all day and I follow them all, pretty closely. I'm still a huge nerd. So I actually have like models on everything. So, I mean, if you ever want to talk about stocks, let me know.
Let's do that. That'll be fun. We do the Twitter Spaces on the energy stocks, and I know Heikkinen, he's like, does the equity research, so he's more up to speed on the details of these companies. But Stacey, thank you for doing this. Again, I really enjoyed it, and hopefully we can do something again soon.
Great.